Hello and welcome to Fintech Diary. Every week we speak to an industry expert who's part of the fintech revolution and innovation. In the world of fintechs, which is based on constant evolution and innovation, we question change makers on how they plan ahead and read the future developments. In every chapter of Fintech Diary, we get the breadth and depth of every segment related to fintech. My name is Amol Dete, and my guest for this chapter today is Ishpreet Singh Gandhi, founder and managing partner, Stride Ventures. Ishpreet, glad to have you.
Thank you, Amol, for having me. Pleasure is all mine.
So, Ishpreet, to begin with, the first question I generally asks to all the guests, taking part into FinTech Diary is about their dashboard, about their, brief about the company. So, could you please tell me, at Stride Ventures, uh, how big is your Stride venture? How big is the company? How many people are working with you? How many customers do you have? How much is the total funds that you have raised till now? And how many startups have you invested in?
Sure, Amol. So let me give you a background about what
Sure.
we do at Stride and then take that specific questions in terms of the stakeholders, etc. So Stride was conceived from a perspective of having a digital bank for digital India. So as we move towards growth stage companies and we talk about startups in the country, including all the sectors and fintech, how do you conceptualize or create a financial institution only meant for them, where they can come and take credit limits, can create structures around financing. So I've been an ex-banker, worked with foreign and Indian banks before realizing that it requires a focused way of creating a bank for startups. And Stride Ventures came in being in 19 with a very clear thought of being sector and stage agnostic and becoming a financial partner using technology for all the startups in the country. So today we have raised a couple of funds under Stride Ventures, two venture debt funds. We are moving towards our third fund, and we funded close to 100 startups across sectors. This includes fintech, consumer commerce, logistics, agri-tech, etc. And we put together with Stride Ventures and another franchise of Stride One, which is an NBFC ourselves. We have close to 200 people now across both the firms. And as I mentioned, it's generally plug and play across industries. So depending on what sectors do we cater to, we create financial solutions for them.
Okay. So you have invested in 100 startups, you said.
Yes. So
Okay.
we have two funds right now. For both the funds put together have close to 2,200 crores of assets under management.
Great.
And we are moving towards Fund 3 under Stride Ventures as a brand. And Stride 1 does the supply chain financing for startups.
Okay. And Stride One has an NBFC license.
Yes.
Okay. Sounds good. So tell me something about venture debt. How do you actually deal with it? How do you actually invest into the startups? What are the parameters, the risk analysis that you did while investing in the startups?
Yeah, so Amol, if you go deeper in the concept of venture debt is providing debt to the startups, and it's nothing but capital, right? Whether you provide, but the only difference is this capital has to come back with a certain form of interest rate. So in today's time or in peak of COVID, what happens when the equity valuations correct or the equity is not as freely available, you go to other avenues of capital to raise for the company's growth, all kind of sectors growth. So, for example, in fintech, we have funded companies like Cred Avenue, Perfios, Jay Kisan, ProCap. Now, they are coming from various backgrounds, various sectors. They have taken capital depending on the use cases. So, our underwriting practices also mirror which industry those companies are coming from. So, a software fintech company will be analyzed in a different manner. A lending fintech company which does personal lending or consumer lending will be analyzed in a different manner. A commerce lending company will be analyzed differently. Similarly, so basic thesis is that these companies should be backed by venture capital firms. They should have raised some amount of equity capital. And the growth element of the company should be very high for us to ensure that the capital which we provide has a very strong, the companies have strong governance and ethics standard to make sure that they can augment that capital to grow the company, pay us back over a period of time, and we do carry equity rights to give us that upside on equity. So the capital providing is done from a perspective of how well the company will be doing in the next 3 years. And that's where you analyze the founders, the investors, the business model, the revenue generation, the margins, the delinquencies in case it's a lending fintech. So you analyze various parameters depending on what sectors we go into.
How many applications do you generally receive in terms of investments or the people who are looking for debt? How many of them you reject, and how many of them you choose? I mean, I understand you invested in 100 startups, but just want to understand how the how actually you function.
Yeah. So for example, last month, since venture debt is more like a capital given in a form over a period of time has to be returned. We across early stage to late stage, including unicorns, we saw 1,000 crores of monthly requirement, and we have funded close to 250 crores last month. Right. So the volumes have been increasing as capital scarcity has started coming in. Right. So on an average, applications wise, we have till date analyzed close to 4,000 startups in the country.
Right.
Every month, we'll be analyzing close to 50. And these are the companies which passes the initial filter, because we don't fund companies which are not venture capital backed. So we would not have a normal startup or a seed startup as a part of the analysis. That doesn't come in the part of the initial criteria to even analyze. I'm talking about the companies which at least have raised one round of venture capital. At least becomes our first element of port of call to look at those companies.
Okay. How much is the minimum ticket size and the maximum?
We are anywhere from 7 crores to up to 100 crores, depending on what company, what stage we are entering. So some of the commerce companies or consumer companies, we have gone as high as touching 3 digits, like so Sugar Cosmetics, MyGlam. Right? We have funded them heavily, depending on their business scale. And similarly, some of the commerce companies.
So I'm asking more questions on this part because fortunately, you as the first guest who's talking about the venture debt on Fintech Diary. So I'm sure the readers and the viewers will enjoy more, and learn more about the venture debt. So when it comes to investments or the returns, Ishpreet, how do you actually calculate that? How much is the interest rate that you charge? Do you look at a tenure, or maybe you just charge a certain fees or something like that?
Yeah, look, there are two forms of return for us, Amul. One is an interest rate which gets paid every month by the company till the time the tenor of the loan is there or the loan is outstanding. Second is the equity upside. We believe 25-30% of our returns will come from the equity upside. So when we do debt, we take closest to the last valued round of the company as a part of certain portion of the debt allocated to the company in the form of options or warrants in the company, which provides an additional upside. So these two constitute the overall portion. Debt typically is priced mid-teens, and then equity portion adds up. So we try to generate a return on investment of close to 20% to 21% per deal, depending on what's the equity upside the companies provide. Luckily, the portfolio, if you see us right, since we have sectoral leaders across markets, they are able to get very good equity upsides. Because if you largely see the venture debt market in India, we've come out with a report also last year which spoke about we have still not $1 billion market in India, whereas in US it's $35 billion. US is 28 billion euros till date in the current calendar year, and India is still at $1 billion. So it's a very nascent market in India, which provides a lot of opportunity to grow. And as equities are picking up, we had $35 billion venture capital flow in the country last year, while last 2 quarters have been subdued. But the overall volumes is nowhere near to the venture debt market, right? It's still 3-4% of the market, depending on what year we're talking about, what time we're talking about.
Considering a great race specifically into startups, considering a lot of rally towards the fintechs, why the venture debt ratio or maybe the approach towards venture debt is really less compared to the global markets or the developed countries? I mean, there will always be a gap which we can understand, but why people have maybe shown I won't say reluctance, but little less interest specifically into venture debt?
Yes, no, very good question, Amol. And it's largely because of the fact that there's been less education about how it can be used. So if commerce consumer companies typical segment starts thinking that equity is freely available and let me dilute and raise equity capital and use it for my business growth in form of working capital, that's actually not the right business logic. because working capital should be financed through debt, and equity should be used for growth capital for marketing expenditure. So largely, when the capital movement goes high, the chase starts there, but it has started seeing a change. So we started in 19. If you see our number of companies and the growth of the deployments in the last 3 years, we've grown close to 4 to 5x every year on the deployments. And we see that trajectory being, if not 4 5x, since the base is becoming higher year on year, maybe 2 2.5x growing every year till the time we believe it's a right scale to be at. So I think education about the founders about the importance of the asset class, that they're not diluting equity. Second, uh, they generally have a very lean finance teams. Founders are very lonely in this journey, so they don't understand the way a debt also works, right? How it comes back, how to be paid back, can it be substituted with equity, or it's a standalone function. So there are certain notions which has to be corrected just to make sure that there is more deployments. But I think it's largely changing. Last 3 4 quarters, post COVID especially, last 3 4 quarters have been very different. So I like to believe that the numbers will be very different. This year we'll definitely cross $1 billion in this industry,
Okay.
and next year onwards we'll be talking about taking it to double of what we're doing this year. So I think the numbers have been really upcoming.
Okay. Sure. Noted your points, Ishpreet. Now tell me something very important, which is really trending today and related to a reality, or maybe it's far more realistic these days, because the buzz on the fintech street today is about the fintech winter, or specifically the lack of investments. Every fintech is telling us that, or maybe the observation on the street is this, that the investors are going really, really slow. They are drilling the fintech founders more than ever now, considering what has happened in last 2 to 3 years, because most of the fintechs could not make money, they are not profitable. What are your observations? Because you're on the other side, you are an investor ultimately, right? You are actually providing capital to the fintechs or the
Yeah.
startups. How do you see? How do you view it?
I have a counter view actually, Amol, on that. So today, one of our portfolio companies was covered called Money View
Mhm.
by ET only,
Mhm.
that they're closing around close to $1 billion in
Okay.
today's time. And I always believe fundamentally strong companies will do well,
Mhm.
right? So the point is, if you look at our fintech landscape, I've been lending to this industry since 2015. I was an early lender to lending card in of business of CISU in
Mhm.
15 16, and since then I've been observing this space. I think fintech muscle will only grow from here. And if investors are giving caution, that's generic caution towards all the sectors, and fintech becomes a part of that. Specifically, one thing which regulator, our central bank, is very concerned about is the fact that there should be proper method towards underwriting,
Right.
right? Who's underwriting whom sometimes becomes complex in some of the fintech models, which is why digital lending guidelines have been coming in observations. That the point is, if you're relying on a banking model and trying to become a partner or a funnel for a bank, and you are not underwriting and bank is not underwriting, who's ultimately underwriting a customer? I think those businesses have been more tricky. But fundamentally, if you go by any thought, right, 35% of the unicorns in India right now are fintechs. If you go by the Bain report recently, we're talking about 3 to 4x of valuations jump in fintechs in the next 3 years, right? So I think the thoughts around that sector for me is very sanguine. I think there'll be a lot of positivity towards banking enablements, which will keep on carrying forward. Neo
Mhm.
banks is a reality. Banks will work closely with a lot of fintechs. That will happen. Software or fintech API infrastructure will improvise. We're seeing a couple of breakthroughs there. Very
Mhm.
excited about that sector. So I think it is bound to stay and get stronger
Mhm.
as Indian economy becomes bigger
Mhm.
and we become more self-reliant. I think technology improvisations will come on more, and we'll see a better evolvement. Short term here and there, 1 quarter, 2 quarter valuations is not a real outcome of good companies and good sectors.
Okay. So one, you're not concerned about the investment part, and you're absolutely open to invest.
Absolutely.
So
I think
funding,
fintech has been our very core theme, and in some cases, we are double down through equity structures.
right?
So I've been, for example, Credit Avenue UB, we have been one of the early backers as an investor during the
Right.
first equity round, right? So we have been always looking at good deals, good transactions. And fintech as a sector really excites us.
I'm sure. So after watching this show, a lot of fintechs will, call you. Maybe they will send their pitches. Be ready for that, Ishpreet. I'm so with that. Ready
No,
with that.
I like to believe at Stride, since we have kind of quite a big team on origination, sourcing, relationships. We've been in touch with the companies we want to be partnering, but we are always happy to explore newer synergies and ideas.
Yeah, sure. So, two questions in one part. One is specifically about when you're investing in fintech. This is absolutely about fintechs. I know that you are invested in sector agnostic type, many other companies also and the startups. But when you specifically look at the fintechs, which are the areas that you want to invest in going ahead, or maybe you are open to invest in any fintechs? Maybe it's payment, maybe it's lending, or any fintechs. That is one part. And second is there any rejection that you want to share with us? I mean, what kind of fintechs you don't like to invest in?
Yeah, absolutely. I'll take the second part first. So
Sure.
fintechs where they're doing lending and the founders or the company doesn't have a lending background, right? And they've started lending because they see as an opportunity to underwrite something without doing it themselves or not coming from relevant backgrounds or not creating adequate team. First of all, we are very particular about founders. One of the founders coming from a relevant background. If you're doing into a lending tech business, whether you're doing consumer or corporate or SME, you should understand as hands-on as promoters, founders, what you've done previously. So we get switched off largely if we believe that we do not, that the company themselves at the top doesn't understand lending, what it is all about, or have not created right management CXO team to even formulate or have a very strong penchant towards that. And I think that's where the fintechs have faltered, who have faltered. From within what overall fintech, what we like, we think that infrastructure, gateways, APIs towards banks and unlocking banks, because banking licenses will be very different going forward, different kinds of banking license. NBFC would be more empowered going forward by RBI. There have been limitations in terms of new licenses coming in, right? So right infrastructure around enabling real financial partners, whether it's banks or NBFCs. So creating tech around that will be an innovation from fintech, and which has always excited us. We still have 3-4 companies in our portfolio, keep on scouting more. And it can be across, it can be wealth management also, it can be insured tech also, it can be in insurance as a segment, right? If you just elongate beyond lending and software. So technology element will be an enablement, whether we form it in the form of, call it in the form of neobanks, we call it in the form of API companies, payment infrastructure companies, or as I said, enabling wealth management solutions or insurance companies penetration. So we've been looking at a lot of companies in that space. Lending, I think, has a lot of companies. Innovative form of lending can propel, but consumer lending, I think, has enough players trying to cater to the similar market. Similarly, SME lending has not been, direct origination has not been very much proven. So embedded finance can do very well if you're going through a channel towards the borrower rather than directly sourcing the borrower through open channels.
That was quite meaningful, Ishpreet. I'm sure the people who are watching this show will really love the insights that you shared. Let me take your observation, maybe, or a perspective, as we call it, on the current fintech, that we have in India. The world has praised the bandwidth of India's fintech ecosystem. We have the great adoption rate of the fintechs. Like you said, 30% fintechs are already unicorns. And we see a great future for that. But most of the fintech, in my observation, are working as an aggregator. Obviously, they will become a digital bank or a neobank in future. That's a different story altogether. But one, how do you see the total India's fintech ecosystem right now? And what kind of opportunities do you see going ahead for the Indian fintechs?
Yeah. So just to correction, I said 30% of the current unicorns are fintech.
Yes.
So look, overall, Amol, how I see this as is, if you see the open infrastructure of government right now, you count UPI in that, you count the newer initiatives which government is coming. I think it's one of the most beautiful infrastructure. You go to US and try to do a bank account transfer through something like a UPI, you would not find one. Right, but you will find that in India, everyone using it. So I think the open infrastructure, what government has created through initiatives like iSpirit, etc., over a period of time, linking account aggregator models, right, is a beautiful stack. I think what you require are smart guys who are trying to work upon that stack,
Right.
right? Take that enablement and create something meaningful on top of that. So any smart, that's why I went to the infrastructure tech companies on APIs or softwares, which is enabling, which is using the current infrastructure well, right? And it can be digital lending. There are account aggregators, there are Aadhaar cards in place, there are CKYCs in place, there are compository in place. There's so much of data bank which you have to exploit as fintechs. So I think if anyone around that using that properly, and that's what excites me towards the sector in general, because the infrastructure laid out by the government is so beautiful, right? So anything around that space of enablement has been quite exciting.
Okay. Noted your points. And my last question, Ishpreet, what's next for Stride? Where do you see yourself? Maybe if I take a roadmap of 2 to 3 years, what kind of changes do you see in your company? How do you want to operate? What kind of funds do you want to raise and invest also?
So look, Amul, across Stride Ventures, our alternate investment fund business, and Stride One, we do close to 500 crore monthly disbursements in startup ecosystem. We only do startups, right? Startup ecosystem. Now we believe the franchise tomorrow, the startup economy in India's economy will contribute anywhere from 3 to 5%. We believe why a Zomato delivery boy should not be funded, why a Ola cab driver should not be funded, why a vendor to a consumer company should not be funded if they're part of the startup ecosystem and startups are getting them into the economy, why a urban company partner should not be funded. So I think the question of becoming a financial partner to startups is what we are trying to address for the past 3 4 years. And our endeavor will keep on going in that trajectory and saying we become the partner, lending partner, tech partner, financial partner in this journey for startups, for themselves, on balance sheet, off balance sheet in terms of funding their ecosystem, an agri-tech farmer, a driver of a logistics company, right, a manufacturer of a commerce platform. All of them who are coming into the economy should also be funded. So our endeavor is to keep on going in that trajectory and make sure the 500 crore number becomes a very different number in the next couple of years. Definitely, we believe that if we are the chosen partner for the startup economy, we look forward to being a more regulatory beyond NBFC, whether it's a digital bank license or the app license, going in that trajectory and creating a very specific name as what Silicon Valley Bank has done in US.
Okay. So considering and what you said, Silicon Bank in US. So will you go ahead and maybe apply for new banks or digital banks once the guidelines are in place?
Yeah, Amul, we've been closely looking at that. We've been closely understanding RBI's perspective towards that. And whatever the right regulatory aspect is, we'll definitely go for that over a period of time. I think NBFC offers a lot and you have to be very regulatory governed. So we are in today's time, since it's become more important, we're trying to just use the right technology with our NBFC platform to enable that through the startup economy, and then ventures provide the balance sheet support. We look forward to building on top of that whatever right regulatory framework we need to be in, and we are open towards that.
Noted your points, Ishpreet. That was quite meaningful. Thank you so much for your time and sharing your perspective on this special show of Fintech Diary. Thank you so much.
Thanks, thanks for having me, and it was a pleasure talking to you. Thank you.
Thank you so much, Ishpreet, for those remarkable insights. And that's a wrap, ladies and gentlemen. Click on Fintech Diary tab to view our previous episodes as well. If you like it, please don't forget to share it on social media. Also, please ensure that you are subscribed to our daily newsletter, which is absolutely for free. Thank you so much for watching Fintech Diary and stay connected to etbfsi.com. Thank you so much.